Hey Shane, how's it going?
Hey man, round two. We just tried to record this video a second ago and I accidentally left the meeting. So, if that tells you anything about how my day is going so far, hopefully I can add some good content for you all out there today, but I am, a little preoccupied. Lots of things moving around and, lots of activity, at Elevate today.
Absolutely. And, we're coming off of, we had the FOMC decision yesterday. Today we had a GDP print that was, the second negative print we've had. So they might tell you based on the historical definition that was a recession, but seems to be changing now. And I know you spoke about that last video. So, for everyone watching, today is July 28th, 2022. And Shane, what are your takeaways? I know you got the Fed funds chart up here. What are you thinking?
Yeah, I figured we just start with the Fed funds rate since that's the biggest change since the last time we spoke. So this chart isn't necessarily up to date or accurate. I don't know exactly how TradingView updates this, but the last print they have here was from June 1st, and the Fed funds rate was down here at 1.21. And as of yesterday, no, yeah, yesterday, Fed raised their target rate by 75 basis points for the second time in a row. And so now the target Fed funds rate is up here in this area between these green lines, between 2.25 and 2.5%. So we are getting back to the pre-COVID highs, um, from which the Fed was actually cutting rates from there ahead of COVID. All the way into February of 2020, they were cutting rates from up around here where we are now, down to around 1.5, 1.75, and then when COVID hit, they dropped it all the way back to zero. So, as it stands, we are now back up here in this range. Um, and so we've got the highest interest rates we've seen since 2019, and before that, the highest we've seen since 2007, before the Great Financial Crisis. So um, those rates are, that's how that the higher the rate, the higher the discount rate for future cash flows. That's how a lot of people will evaluate an investment, is based on the present value of the future cash that business will generate. And so, $100 generated a couple years in the future now needs to be discounted at a much higher rate than it used to, which brings the present value down. So we'll see what happens. We'll see if those the discounters out there of the world actually do so, or maybe we've got the bear market bottom in behind us. You never know until it's over. So right now, though, we see some higher interest rates out there in the market, and that means that's, the cool thing is for savers is we actually saw some pretty good fixed rates out there, 2-year fixed products at 3.5% guaranteed, and we can buy U.S. Treasuries that mature in less than 1 year, that are paying I think about 3%. And at Interactive Brokers, one of the custodians we use, if you just have idle cash sitting in cash at Interactive Brokers, you're now getting, I think, a little over 1.8%, without having to buy a treasury and without having to commit your money for any length of time. So if you all out there have a bunch of cash sitting on the sidelines and you're not earning at least 1.8%, you might want to consider taking a look at the folks over at Interactive Brokers.
Yeah, it sounds like a great place. Put some cash right now if you're just trying to earn something.
Yeah.
Always better to get more than zero. So,
Yeah.
and,
Not
and
going to be keeping pace with inflation at 1%, but US dollars have rallied like 20%. So it's a function of, relativity.
hmm and it's interesting too, is just with rates going up like this, I think the assumption is stock market's going to tank, and we saw something much different than that yesterday. So I don't know. I'm
Yeah,
sure
let's
you'll get
jump
to
over
those
to the
charts.
SPY. Might as well just jump into the SPY chart now. I mean, we talked a lot last time about how the economy and the market are not the same thing. So the economy can be in really bad shape and the market can rally. We saw that all year. In 2021, we had a really poor economy, and the market decided to rally the entire year anyways. Subsequently, gave back all of those gains, but is now trying to put in a bottom and march its way higher again. So, yeah, looking at the S&P 500 via the SPY ETF here, and what we see, I mean, what I mostly see, and you can't really see here where it says gap. Um, But as of yesterday, we filled this gap right here. You see the gap in these two prices. We have now officially gotten above the high part of that gap, and the market is trying to continue in rally mode here. So that's pretty optimistic. It's a reason for even a technical analyst to go ahead and be bullish. You saw a breakout of this downward channel, so we broke out here. We rallied above the 50-day, came back down, as I think Kyle was talking about last week, retested and bounced off of that 50-day moving average, and now we're going higher. So looks like for now the trend is looking up for the first time in a while. Doesn't mean the bear market's over, but we're definitely trending higher for now.
Yeah, and it's interesting on this one. I like how it came back and back tested the 50-day moving average. So short term, that's a positive indicator on that one. From a money management standpoint, though, we talked about this. We're not trying to pick the bottom here, and we could be as bearish as we want and still make money here. And it's really just letting this confirm. And when it really does show this is a bull trend, take that excess, cash, bet a little more, and it's a lower risk entry, and you still have that upside. But I think right now I'm looking at that orange line you drew. So that's that next level. If we break above that, back test it and continue on, then I might proclaim this bear market's over, but I'm still a little skeptical.
Yeah, 415 to 417 roughly is probably the next stop, I would say. If I draw a line at the high here, it's right around 417. So up there is probably the next stop is my guess. But yeah, if we don't get above that, then I could easily see us rolling back lower, even to a new low. And as we looked at, last week, if we went back to 2008, 2009's bear market, there were plenty of rallies. I mean, some were 20%, 26% higher, and the market still ended up making a new low from so far from the lows that we saw at the end of June to where we trade right this moment. We're still only up 11.34%. So you can see that here on this red line, we're up 11.34% from the lows. Interestingly, I was just looking at it a minute ago. When you measure from here, from the lows in February to the high at the very end of March, that was actually a rise of 12.58%. We got above the 200-day moving average, and everybody was calling the end of the bull market right there, because we had broken the downtrend, right? If that was the downtrend, we broke above the 200-day moving average. We broke above the prior highs right here, and everybody wanted the bull market. They were like, bull market or bear market's over. We're now back into bull market mode. And of course, what happened was we we broke back lower and lower and lower and lower. So there's, even if you just study this current bear market, there's really no reason to believe that the bear market is totally over. There are reasons to be bullish and there are reasons to be bearish. So you can't put all your eggs in one basket. I think if you are holding a lot of cash and you had the fortunate experience of selling stocks, back up here, and now you can put the money back to work down here, then you should be putting some of the money back to work. But that doesn't mean you have to put it all back to work all at once. And it doesn't mean that we're totally done with this bear market yet. So we'll see what happens, but wouldn't surprise me now that we've cleared this gap to see us run up to the 415 to 417 level, and then probably consolidate and at least take a breather. Whether it breaks down or higher from there will be very important. But ultimately, the long-term trend, we're still under the 200-day moving average. We're above the medium-term trend of the 50-day moving average. So we're in the in-between now. So I'm a little bit more bullish than I probably was last week, but we'll get to a few things here that, in the economy, there's lots of reasons to remain skeptical of this rally.
Yeah, and it's interesting. So I was just reading Peter Lynch's book, One Up on Wall Street. I don't know if you've read that book, but he was talking about when it comes to stocks, playing it like you might play Texas Hold'em or a similar game. And, as the cards come out, if anyone's familiar with that game, you can bet on the first few cards that come out, but you don't want to bet at all. But as you start to get towards the fourth or fifth card to come out and you have all that information it's showing, you have a very high probability of winning. That's where you can bet a lot of money and do pretty well. right now we're still early in that. So we can wait until we get up over that level, back test it, and then really slam on the gas. But this just still doesn't, tell us that the bull market is back in gear. I think we're just getting a nice rally here and we'll see what happens, but still definitely putting caution out there.
Yeah, I mean, even if you just bought at the 200-day moving average, you still got 10% of upside before you could make a new all-time high. So I mean, there's good money to be made right there. Even if you just wait all the way till the 200-day moving average and we stay above that, and you still got plenty of room to make money, especially if the market is actually going to rally to a new all-time high, because technically the bear market isn't over until we rally above 479.69 and put in a new high. So you don't want to wait all the way for that, I don't think, to start putting money back to work. But above that, that's when you can be really confident that something has changed and the market's looking back higher. So
Yep.
anyway, let's move on to the Qs. Not really much different. Pretty similar, actually. We broke out of the channel, came back, tested the 50-day moving average, and now rallying a little bit. Still not quite above the prior high here, and still haven't gotten back into a point where you would have gains if you had actually bought back here in December of 2020, at the end of the year 2020. So still the Nasdaq, as measured by the QQQ, is still trading below where it opened the year 2021. So it's more than given back all of its gains from last year. That's no surprise in a rising interest rate environment. The tech stocks tend to do a little bit more poorly. They have to generally borrow money to finance their growth, and so borrowing costs going up lead to lower valuations, as I was talking about before. And so the Nasdaq is still way down. So buying stocks like Google, for example, which is way down off of its highs, you can still make a lot of money. In fact, I'm just going to jump over to a Google chart real fast. For Google, if you wanted to buy it here and put a stop right down here at 99.50, which was the lows back in February of 21. Those lows held recently in May, and now we're kind of breaking out of this consolidation phase. It's not a very clean breakout, so it may not actually work. It may still fail, but earnings missed. Sales revenue actually missed when they reported, but the stocks go up anyway. So, seeing a stock go up on essentially what's bad news is kind of a bullish thing. Google's still a good company. It's still relatively cheap compared to a lot of other mega tech or mega cap, big tech companies. And if you bought here, there's still 15% of upside just to the 200-day moving average. And to get back to the all-time high up around 150 on a split adjusted basis, there's still 34% of upside. So, I mean, you can buy Google here and expect 34% if the bear market's over and Google's going to rally back to its all-time high. That's 34% upside and only 11% downside if you use 99.50 as your stop. Arguably, you might want to move your stop all the way up here to 102, right, at the recent low. But at any rate, if you risk 11% to make 34%, that's better than a 3-to-1 risk-reward ratio. You only need to be right 1/3 of the time to break even. So that's a great trade right there. And if you're not considering at least adding a little bit money back to Google at these levels, I guess I don't know what you'd be waiting for.
Yeah. And it's nice too. We have that earnings catalyst out of the way. So I see putting your stop down there, but unlikely to get wicked out. That's what they call it when price moves down sharply and bounces right back, hits your stop order and takes you out of that trade. This is one where now it should just kind of grind in, the prevailing direction, which seems to be up for the near term.
Yeah, and I mean, I said don't add to your losers, but I think if you had like if you were targeting, say, $100,000 in, say you were going to put 10% of $1 million account into Google, you could probably buy half of the position here. And as long as it stays above your stop, you can just keep adding at a slightly lower price. I wouldn't add to it below here. I'd be stopped out down here. But let's say you bought 50 grand here today, and let's say it drops to the low end of this consolidation. Well, you might buy another 10 grand. And let's say it drops to the recent low. Well, you might buy another 10 grand because from this point to the your stop, it's only 4.7% of risk. So now you're risking 4.7 or 4.27 to make, closer to 40, 46, almost 50% upside. So the risk reward gets better and better as long as it holds above your stop level. But once it goes below that stop level, you gotta cut your losses and admit you're wrong. So um, that's how we like to start positions, or I would certainly like to start positions, is don't buy it all at once. Let's say I've got a certain target size in Google. I'm gonna buy half of it, maybe even less than half of it here, depending on how much confidence I have. And as long as it holds above my stop area, I'll be looking to add to it and take a full position kind of over time. Certainly, if it goes higher, I'm going to keep adding to it, because that's just, as it goes higher, you get confirmation that you were correct. And so you always want to add to your winning positions for sure. Adding to positions that are down a little bit is a little bit of a different game. I don't like the idea of averaging down. I'm not the kind of guy who's like, if you liked it at 100, you'll love it at 90. That's not how it works. But as long as it holds above your stop, you can get away with nibbling a little bit more, but you got to honor that stop. So wherever you put
Yeah.
your stop, that's up to you. This is where I would probably put mine on Google.
Yeah. And then what about, I see Tesla up there. That's another one that seems to have made a turn.
Yeah, I mean, I hate this company. I royally hate the CEO of the company. I think he belongs in prison. Hopefully that'll happen eventually. If you can lock up Martha Stewart for insider trading, you could certainly lock up Elon Musk for all the crazy stunts he's pulled, especially, lately with the Twitter deal. So it sounds like he got re-subpoenaed about his taking Tesla private tweets that he sent when he was lying about that. So, I don't trust the guy at all. I don't think he's a very trustworthy guy to run a company, and I certainly wouldn't be investing in him. But as a trade, I mean, what can you say? It's breaking out. I think you probably will run into resistance up here at the 200-day moving average. So maybe only 8.6% of upside to that 200-day moving average, where it might stop going up, but shoot, 50% still of upside back to the all-time high. If you really believe in it, you're getting Tesla on sale at this point. But holy moly, the company's still crazy expensive, right? If we go here, it trades at 99 times its earnings, trades at 14 times its sales. The good news is that the sales are growing, right? So steadily growing from 4 billion back in 2015 up to 67 billion over the past 12 months. So, it's a growing company. They're doing more and more business. The United States just passed some well, I don't know if they passed, but Joe Manchin finally agreed last night on some legislation around climate change and all that kind of stuff. So all the electric vehicle stocks are rising today based on, some legislation. So I think there's some catalyst here. Again, Kyle, I don't know where you'd put your stop. Maybe put it right there at that 793 level, or maybe just down here at 767. So, depending on how much upside you think, you got 8% downside to the recent low on this drop here, and about 8% upside to the 200-day moving average, but 50% upside to the all-time high. So depending on how bullish you are and where you think it can go, you got to choose your stop accordingly. And I think long-term believers in the company and in Elon can certainly afford to take a shot here.
Yeah. And on this one, separating technical analysis from fundamentals, technical analysis, you're really measuring the risk reward. So risk reward here looks great. The other thing is that it kind of reads into the idea that perhaps the fundamentals change coming out. You might not be the only investor with that view on Elon Musk, and perhaps the market anticipates somebody else coming in who's even better. You never really know, but the chart's telling us it seems to want to move higher. So I like that.
Yeah. Next here we got gold on the list. So gold is look at that, man. As we said, for long-term holders of gold, right, as a chaos hedge, you could afford to take a shot down here with this as your stop. So gold's made a nice big move off those lows, up about 5.5%, and looks to be heading higher. So we got the 50-day moving average will be resistance here soon, and then 200-day, and who knows what happens after that. But gold is getting up off the mat, as they say. So I wouldn't be trading this long as like a trader, but again, long-term holders of gold might be interested in adding to a position here, depending on where they got in. So I think it's still got some work to do before it gets out of the downtrend that it's in. But that's
Yeah,
how it looks.
and this is tough. So this is one where I did add gold to my portfolio, but the idea is it's a mean reversion trade at this point. It just got so oversold down to that main level that's been intact for quite some time. So you could go long there, but it's still just a choppy chart. And it seems like every time it rallies, everybody goes on Twitter and everywhere else and starts talking about how the inflation is here. Buy gold. It's going so, these price forecasts they have on gold are so high. And I'm highly skeptical of all of that, but right now we just have a bounce and that's all it really is. So again,
Yep.
just it's a chaos hedge. That's it.
Yep. You got it. Crude oil building some consolidation here around the 200-day moving average, putting in some higher lows. Looking pretty strong. I like the look of this. Draw your line here. It's breaking out. Not with a lot of strength, not very clean. But I think you can get away with a buy here and a stop down here. So it's not a bad trade. Not a bad trade at all.
Yeah, and I agree with that one. It's consolidating nicely here. I think once it breaks 100 and retests that, then you're going to see it start to move up pretty quick. But right now it's still just consolidating a little bit.
Yep. Rates. So Fed raised rates yesterday and the 10-year yield is falling. So Kyle, you had an interesting story about, expectations versus actions in the bond market kind of, reacting to what the Fed was going to do. So I'll let you take that one, but interesting that you see rates going down. Fed raised rates right here. So you would
And
think that the rates would go up.
yeah, this is a good reminder here. So this came to be just, I'm shopping for a house out there and the agent had reached out and said, hey, do you want to lock in the rate? Because the Fed is going to raise rates. So it's that simple. But the problem is, so the Fed, they are able to interact with the front end of the curve. That means the very short term rates, but the longer term rates, 10-year and out, is determined by supply and demand. So in this case, the market really has priced it in already. And what you're seeing now is if you look at this chart, rates are going lower. So mortgages are based off the 10-year. And right now, I think what this is telling us a bit is that, rates are coming lower. And I think the market's starting to say, hey, I think the Fed, they really want to raise rates, but they're probably going to stop a lot earlier than most expected. And that's what you're seeing here is, and that could be that they push us into a recession and go, oh boy, we pushed it too far. Let's back off and try to get things to come back. And I think that's what's telling us a bit is that, longer term rates, they're not going to move up like people are thinking. You get that yield curve inversion because you push up the short end and then the long end, either stays there or goes lower. So now it's more expensive to borrow short term than long term. So we'll see what happens here, but I'm not too surprised that we're seeing the 10-year rates come down and the 30-year.
Yeah, what is the 10-2s doing?
It's probably pretty ugly today.
That's not it. Hold on one sec. I gotta find it. 10. This is the one.
Yeah, I think that's it.
Oh, it's just adding it. Hold on here. I see what I'm doing wrong. 10-2. There we go. There we go. So yeah, still well under the 0 mark here. So this is still have an inverted yield curve. I know one of the other yield curves that the Fed follows, I think it was the 1 year minus 3 month or something like that, was also inverted as of yesterday. So a whole bunch of inverted yield curves, not good for the economy overall, and usually signal a recession coming soon.
Yep. So we'll see what happens, but it's not a good sign when you have a inverted yield curve. So
Right. Let's jump into Bitcoin real quick here. And then I gotta delete this guy. There we go. So Bitcoin has bounced nicely. We're above the 50-day and well below the 200-day. But over this level, I'm constructive, right? Bouncing over the 50-day. It did drop below the 50-day for a minute there, where I think I told you guys I bought some Bitcoin and had the 50-day as my stop. So I sold actually half of my position on this day here when it dropped below, but I kept the other half. So I sold half of it for a small loss, and I'm up a little tiny bit on the other half. And I might be looking to add to this if it continues to signal, higher lows. So that's pretty constructive. For now anyway. We'll see what happens. Bitcoin's very volatile, and it wouldn't surprise me at all to see this thing break below and go all the way down to 13.8. But if the bottom's in, you want to at least start putting your money back to work around these levels, and then just follow your stops. So I've taken a shot with Bitcoin, and again, this is in my personal account, and we'll see what happens.
Yeah. And I think on this one, you could draw lines and say we're still in a channel on that lower leg, but you start to look for those, I guess, shorter term indicators. So we did cross the 50, retested it, and it's going higher. So this is a cautious long here, but I agree. I think it's starting to look a little more constructive.
Well, and I think the biggest thing, and probably what'll put some pricing power underneath gold and underneath oil, is that the dollar index. The dollar index has kind of fallen a bit from the highs, right? So back here, I was talking about how the US dollar was up over 18% in the past year, while inflation is only up 9.1%. So, holding dollars actually would have worked out pretty well. I know a lot of people say, well, geez, I'm just holding cash. I'm losing ground to inflation. Well, this says otherwise. This says holding cash, you'd be up 18% over the past year, while inflation only went up by 9%. So holding dollars is actually a pretty smart thing to do while prices, especially if stocks and bonds are falling, even though prices in the real economy are going up. That's a whole different can of worms we can't really unpack right now. But most importantly is what I wanted to look at right now is that dollars are actually dropping. Since about July 14th. And even though the Fed raised interest rates yesterday, dollars actually down a little bit because some of the things that Powell said was that they were going to ease the pace of their rate hikes. So even though they've raised rates from 0 to 2.5%, now they're only trying to get to 3.5% by the end of the year. So that means we're pretty much done with 75 basis point rate hikes, and they'll only hike by maybe 50 basis points in the upcoming meetings. So again, it's all an expectations game. Rates are still probably going to go higher. Inflation's still going to stay extremely high based on any historical standard. But because the pace of the rate hikes may be slowing, people are looking at that as lost the recording.
Yep. I think it's still recording.
Oh, now it's recording. I heard it go back to regress. So anyway, sorry for that, guys. Maybe we'll have to edit that out if you lost the feed for a minute there. But anyhow, yeah, I see potentially the dollars kind of coming off of their peak, and we'll see how that works out. But if dollars continue to fall, then gold and oil and Bitcoin can easily continue to rally. So
Yep.
see how that goes. Now on to a couple of other things. I know we've probably taken up a little bit too much time already, but other reasons to be bearish. Walmart recently updated folks on second quarter and lowered their profit outlook, lowered their margins, and if you read through everything that they said, negatively affecting gross margins. This is just due to higher inflation. Food inflation is double digits higher than at the end of quarter one, affecting customers' ability to spend on general merchandise categories and requiring more markdowns. So that's good for inflation, right? Prices coming down to move through the extra inventory, particularly for apparel. So people are spending more money on food and energy and less money on new clothes and new shoes, which is really no surprise. The increasing levels of food and fuel inflation are affecting how customers spend. Made good progress clearing hardline categories, apparel, and Walmart US is requiring more markdown dollars. So that could be good for inflation. Probably going to start coming down a little bit. Probably not due to anything the Fed has done, but just due to normal course of business. So Walmart dropped about 10% on the news. So when if we pulled up a Walmart chart, you'll see that, oh wow, look at that, it's recovered pretty nicely. But from here to here on that announcement, dropped a little over 10, well, right around 10% to the lows, I think. So that was not good overall for the stock, but looks like it's recovering pretty well.
Mm-hmm.
Do you have anything to add?
Nope, just quite the drop there, but bouncing back. So I think that's telling you something. Might be putting
Yeah,
nice base in.
maybe. I had a chart that I'm gonna have a hard time showing, but I'm gonna maybe I'm gonna try. Hold on one sec. Let me see if I can stop sharing this and start sharing this. I'm gonna go here. So I don't know how well you can see this. Last time we shared PowerPoint, it didn't really work very well, but I was just showing this consumer inflation official versus shadow stats, which is shadowstats.com. They basically calculated CPI the same way that the calculation was done back in 1980, in the early 80s. And what you see is the blue line. Inflation would be well over 15%, almost 20% if we measured it the way we used to back in 1980. But because they've changed the way that they measure CPI, it's down here at only 9.1%. So, if you were alive back in 1980, and you remember going to the grocery store and buying gas and all that, you may have felt like prices, the price increases today are every bit as bad, if not worse, as they were back then, and wonder why doesn't the government report it that way? Well, they like to change the way they measure things to put the ball in their favor. So if you didn't change that, it would be a lot worse. You could say the same thing about unemployment rates and things like that. If they measured it the way they did back then, the unemployment rate would be a lot higher than it is now too. But they have changed that over time substantially in their favor. So
Yep, and
interesting.
yeah, interesting diagram for sure, or chart.
So back to the website side of things. This is interesting. So this was on July 21st from the White House, whitehouse.gov. What is a recession? And this is, this is ahead of the GDP print that we got this morning, showing that GDP was down for the second consecutive quarter. So a few days ago, ahead of this, the White House started preparing us for the fact that it was going to be worse. And while some maintain that 2 consecutive quarters of falling GDP constitute a recession, that is not the official definition. Interestingly, I wrote about this in my market commentary, I think back in April. And last month I said the only way that we are not currently in a recession is if the Fed and the White House get the folks over at the NBER, which is the National Bureau of Economic Research, if they get them just to simply not declare an official recession. And it looks like that is pretty much what the plan is. So funny. This says, based on this data, it is unlikely that the decline in GDP in the first quarter of this year, even if followed by another GDP decline in the second quarter, indicates a recession. So they were front running the number, which I'm sure they knew what the number was going to be. And of course, this morning we got the number, which shows over here quarter one and quarter two below the gray line. So you know that both of them were negative. So in first quarter, GDP shrunk by 1.6%. In quarter two, the initial estimate at least is that it dropped by 0.9%. So you can see that out here at bea.gov. You can find the GDP estimates. This is just the first estimate, by the way. They're going to update this 2 or 3 more times before they call it final. So this 0.9% could change. It could get better. It could get worse. So we'll get a couple of updates to it. But again, they're highlighting the smaller decrease in the second quarter, primarily reflected in upturn in exports and a smaller decrease in government federal spending. So we do have the second consecutive quarter of falling GDP, and it feels to me like we're certainly in a recession here in the United States, but it doesn't seem that way to the White House or to the Fed. So, I guess I'm probably wrong, but we'll see what happens.
Yep, I appreciate redefining, bad outcomes with new definitions,
Yeah,
that could solve a lot of the world's problems. So
yeah,
I appreciate the thought.
right. It's pretty funny how that works. Changing definitions is hijacking language and then using it for your own benefit. It's pretty suspect.
Yep.
So one thing that I see in the economy that leads me to believe we're probably still not totally out of the woods yet is that auto loan balances have skyrocketed. They're just huge, and that's partly due to the fact that cars have increased in price so much. But check this out. According to Barron's, there's been a surge in repossessed vehicles over the last year. Auto dealers are seeing repossessed vehicles go to auction where the buyer's loan to value is north of 130%. So that means the car is worth less, excuse me, than the loan. So you borrowed more money than it would take to just leave the keys in it and go rebuy the car somewhere. So they put it in perspective. Like buyers are defaulting on car loans. So the loan's 26,000, but the vehicle is only worth 20,000. For example, that implies 130% loan to value ratio. That's crazy.
Mhm.
I've been pricing cars. We're in the market for a new car, and they're still insanely overpriced. Like a Ford Bronco is like $80,000, one of the new ones, and I'm just like, why would I do that? I was just gonna wait until I can get a used one that's been repossessed by somebody who didn't want to pay the bill. Because interestingly, subprime borrowers default rate has increased from 6% to 11%, and that's for the subprime guys. For prime borrowers who have good credit, the default rate has already doubled from 2% to 4%. So this means people with good credit are are just leaving the keys in the car and letting them be repossessed because there's no, I mean, once you see that you owe more than the car is ever going to be worth, right? Because car is a depreciating asset. It's not generally going to be worth more in a couple of years than it was when you drove it off the lot. Um, Over the past year or two that relationship has inverted, but it's not likely to stay that way for very long. So people are looking at it and saying, gosh, even if I default on this loan, I can probably still go get a different car and make the economics a lot better. So I don't know, not a sign of a good healthy economy when you see prices like that in the used cars or new cars. And this is the Barron's article that shows car repos are exploding, and that is a bad omen. So, um, yeah, I don't know. It's not quite the same as defaulting on your home. So I don't see it being a 2008, 2009 style like mortgage crisis. But it's not a good situation to be defaulting on that many cars.
Yeah, definitely something to pay attention to. And I'll put the link to this in the show notes. So if anyone wants to read that, but just one thing you might look at in the economy to see that things are slowing down a bit.
You got that right, my friend. I think that was pretty much it. There's just one more here from Edmunds. It shows that average amount financed for a new vehicle ticked above $40,000, and shoppers paying over $1,000 a month for payments, highest ever. I mean, thousand, that's a mortgage payment back in the day. I don't know what people are doing, spending $1,000 a month on a car. I mean, you can see that they're being repossessed. That's what they're doing, is committing to it and then saying, wow, this is stupid. Maybe I shouldn't do that. So
Yep.
another interesting article from Edmunds.com just kind of showing like what is going on in the world. Something's not adding up, even though the market can keep rallying. The market and the economy are not the same thing. So we'll see what happens with the stock market. But in the general economy, prices are incredibly high. People are defaulting on their car loans. And what happens when you get your car taken away? I mean, just think about it. Like you don't have a car, you can't get to work. If you can't get to work, you can't go buy groceries and buy apparel at higher prices at Walmart. It kind of trickles down. So to me, there's still a lot of bad stuff in the economy that needs to get cleared out from all the money printing. And even though the Fed is slowing the pace of its rate hikes, it's still hiking rates. It's probably going to continue still hiking rates, at least for a little while, unless the market really crashes. And at the same time, they're reducing the size of their balance sheet by selling bonds or not replacing bonds that mature in that market. So I think there's still a lot of reasons to be cautious, but the technicals for now on the stock market, at least for the S&P 500, are looking up. So I think it's time to be putting some money back to work, keeping some nice tight stop losses in place in case this isn't actually the bottom, and following those when the time comes.
Yep. I agree. So, well, Shane, thanks for taking the time again this week to walk us through all this. And I think it's been value added. So we'll see what happens next week if the rally continues.
Yeah, it's continuing for now. I'll try to have a little bit better togetherness next week. This was kind of scattered all over the place. But anyway, thanks, Kyle. Good talking with you, man.
Absolutely. Thank you.
See
See
you.
ya.